Okay, so we're gonna just do a random shit. ADR, and then we're gonna have risks, and then we do the synonyms. An ADR is an American depository receipt. This is a security, like a foreign security, trading here. That's if you stop right there, you're good. What happens is like a U.S. bank, like Bank of America, will have a branch in Switzerland. They will buy shares of Nestle, wrap it up, and then sell the package of wrapped up securities in the US. So this is an ADR, but it holds Nestle in there. So it moves up and down just like Nestle does over there. And like when both markets are open, they probably move very close to each other. But once one market is closed, they may move independently of each other. Now, here's a couple issues with it. If you pay dividends, so say it pays a dividend, Switzerland goes, whoa, we're not letting the money leave. We're going to tax it before it leaves. So if you get a $2,000 dividend, boom, they take their $100 or whatever. You get $1,900. Then you come here and you get credit, you $1,900 dividend. The IRS goes, well, you owe us $500, but oh, you paid $100 to the other country. We'll credit you $100, so you pay $100 less. So whatever you pay to the foreign country will be a credit on your taxes here, or a deduction, whichever it works out. Now that's an ADR. A global depository receipt, I can't speak, is the same thing, but it's not just the US. It could be like Nestle trading this shares trading in United Kingdom and the US, or Australia and Japan. So it's more than one country. So an ADR is one country in the US, traded in the US. A global depository receipt is the same thing, like Nestle trading in multiple countries other than Switzerland. That's a global depository. Then we have the over-the-counter market, OTC. This is where instead of on an exchange that trades between dealers, so we have the pink sheets and OTCQX and OTCQB. So the OTCQX and B, the differences are minimal. But the difference between pink sheets and OTCQX, it used to be called the over-the-counter bulletin board. It's over-the-counter trading. These are quote services. To be listed, shouldn't use that word, on the OTCQX, the company is not on an exchange, it's too small, but it does submit its financials, 10Qs, 10Ks to the SEC. Then they could trade on the pinks or the OTCQX. But if you don't have audited financials being submitted to the SEC, you can only trade on the pink sheets. So pink sheets are for the over-the-counter securities that are not registered or submitting financials to the SEC. OTCQX and QB are for companies that they're not big enough to be on an exchange like NASDAQ and New York Stock Exchange, but they are submitting their financials to the SEC. So a little safer, still low. Now, we talked about it earlier in a previous video. Penny stocks are stocks trading under $5 and trading on these two exchanges, trading with pink sheets and OTCQX off an exchange. So a penny stock is under $5 and not trading on exchange, either trading pink sheets and over-the-counter bulletin board. Not every stock on the pinks, the OTCQB, QX, whichever one you want to go with, are not automatically penny stocks unless they're also under $5 a share. Prime broker. A prime broker is like usually for hedge funds or really big customers. It allows customers, hedge funds, to use one firm to hold their money and their assets and other firms to execute. So the prime broker holds their assets. And then if I want to execute through Dewey, Cheatham, and Howe, but say JP Morgan is my prime. I'm a hedge fund. JP Morgan is my prime. They own my securities and my money. But I want to use Dewey, Cheatham, and Howe to execute. Say that slow. Dewey, Cheatham, and Howe. And I'll have an account with Dewey, Cheatham, and Howe, and my money's at the prime broker, JP Morgan. When I execute through Dewey, Cheatham, and Howe, they have a relationship. They will let the prime broker, JP Morgan, know that I need this much money or these shares from my assets. They'll deliver it to them, and then they'll clear the trade. So our prime broker allows a hedge fund or a large customer to hold all their assets in one place and then use different places to actually execute the buy and sell. That's a prime broker. Usually really only for large institutions or hedge funds. I haven't done these yet, but the 4 business cycles we worry about, their expansion, when GDP is rising, prices are rising, things are getting better, and the Federal Reserve will raise rates and sell treasuries, just tighten it up so it doesn't go crazy. Peak is when it's near its top. And what happened, we have what they call disinflation, where it's still rising, but less, and that's like the top. And then we're going to have contraction, where the GDP, the gross domestic product, is dropping. And it's getting lower. We have higher unemployment, lower price, maybe deflation, but that doesn't really happen. And the Federal Reserve, through monetary policy, will start lowering rates and buying treasuries from the bank. They're easy money, right? Loose money, okay? So during expansion, they tighten and raise rate. They tighten by selling treasuries to the banks and raising rates. I have whole videos on this. During peak, probably the end of peak, they'll start loosening because they don't want to drop off a cliff. as as the economy drops, the GDP drops, the prices may drop, maybe. They'll start loosening by buying treasuries from the banks, giving them money, and lowering the discount rates. And then we have trough, which is the bottom. Like hopefully we're going to head up again after that. So we want this, right? So expansion, peak, contraction, trough. Expansion, peak, contraction, trough. We don't want this because that's crazy time. We want this down a little up. Like you want it to steadily going up, but you'll always have to have downs. You always have to have downs at some point. Now, if, despite what administrations say, if you have 2 negative quarters of GDP negative growth, with down, it's a recession. If it's 6 quarters, it's a depression. And we're on to the risks. Now, some of the risks I'm going to talk about, I will mention the synonyms, so hopefully I won't re-mention them again when I do the synonyms, okay? But it may happen. Shit happens. I'm an idiot. Okay, so let's get into it. First of all, market risk, systematic risk. Market risk and systematic risk. The risk that the whole market tanks. Doesn't matter how good your stock is. If the market's down, you're down. So systematic risk and overall market risk. So again, the best 2 examples, now we have 2. March 13th, 2020, the 2 weeks for the cure, the whole market went down. Even the strong companies, no matter what you did, Meta, Amazon, Tesla, Nvidia, making money, they still dropped because the market went down. Now this, April 3rd, 2025, in case you're watching this, when he announced the crazy tariffs, the market dropped for 4 days in a row. No matter what you bought, you lost money. That's systematic. That's market risk. You cannot diversify that away. Remember that. It's also called non-diversifiable risk. Business risk, unsystematic, non-systematic, company-specific risk. Risk that your specific company goes down, screws up, but for whatever reason, it does not affect the whole market, just that company. You want a stock in a retail chain, then they go bankrupt, you're toast, even if the overall market is fine. Just like that. Or like right now, maybe if the tariffs are bad on China, you own a Chinese stock. It's just that's not a bad example. But understand if your stock does bad and it doesn't affect the whole market, that is non-systematic business risk, company-specific risk. How do you get rid of it? You can diversify away. Most things, a lot of things you can diversify away. Systematic market risk, you cannot. A lot of things you can diversify away. So if you just own one stock, you have a lot of non-systematic business risk. But if you own a bunch of stocks, a big diversified portfolio, you have much less business risk. Okay. Credit risk, otherwise known as default risk or issuer risk. The risk that a bond issuer, bond only, can't pay you back, missed interest or default in total. Okay. So again, credit risk, default risk, issuer risk all mean the same thing. That's for only debt. It's only debt. Only debt. Okay. So again, it's only for bonds, ETNs, debentures, munis, not really treasuries, is not a thing, and corporate bonds. Any kind of bond has default or credit risk. Even convertible bonds have default or credit risk. Interest rate risk. It's basically the risk that when you buy a fixed income, whether it's preferred or a bond, that the interest rates rise, and since your bond is not as attractive, the price will drop. So again, when you buy a bond or a preferred, you get a set coupon. If the rates rise, the price of your thing looks less attractive, so the price will drop. So if rates go up, prices go down. That's also called rate sensitivity or technically duration risk, okay? You buy a bond at 4%, next year rates jump to 6%, your bond value drops because nobody wants your weak 4% bond. Reinvestment risk, there's no other word for that. You get paid interest, but now you can't reinvest it at the same sweet rate you had before. You had a bond paying 6%, now rates are at 3%. As you're getting paid your 6% every 6 months, the only rate available to reinvest your money is at 3%. A lot of people put this with call risk. I'll see if I have it on my list. Call risk is a risk that the company calls a bond back early when rates drop. That they kind of conflate the two. I guess I understand because if you get the money, you have to reinvest it. But the whole point here is that reinvestment risk is as you're getting paid, you're going to reinvest that money at a lower rate because rates have dropped. So you're still earning your 6% on your original bond, but you're only earning 3% on any new money that you reinvested. So that's reinvestment risk. So bottom line, when you own a bond or fixed income, if rates drop, you have reinvestment risk, the risk that rates go down, you'll have to reinvest at a lower rate, or call risk that they're going to call the bond back, and that's not good for you because then you owe all this money, they have to reinvest at a lower rate. Inflation risk, also known as purchasing power risk. Your money loses value because prices go up. You still get your payment, but it buys less. So do that again. You have a CD paying 2%, but inflation is 5%. You're technically losing money. That's why I have a thing called real rate of return. Your real rate of return is your return minus inflation. If you earn 8% and inflation is 3%, you actually only earn 2% because, yeah, you're getting 5%, but prices have gone up 3%, so you're getting 2%. Okay. So again, Inflation risk, purchasing power, is a risk that prices of goods go up, and your fixed income, it's mostly for fixed income, bonds and preferreds and CMOs, anything that pays a fixed income, fixed annuity, they only pay the same amount every single month or quarter, whatever it is. So what happens is your money is buying less. Okay. So if you're getting $50, let's say you're getting $50 a year, okay, from bonds. And back in the 80s or 90s, the movies, when I first started teaching, the movies were $5. So you and 9 friends could go see the movies for $50. Now, fast forward to 2025, movies are $25. You could go alone and get a popcorn and a soda and have a little money left over. Because if movies are $25, let's say movies are 20, you can bring one friend and maybe get a bucket of popcorn for the same $50 that will bought you 9 tickets in the 80s. So it's all about, if you're getting a fixed income, prices of goods and services go up and your shit buys less. Liquidity risk or marketability, same thing. The ability to sell your investment quickly without losing money or waiting forever. So if you own shares in if you see the word closely held, private company, small cap, unlisted, non-tradable, any of those things, non-exchange listed, unlisted, over the counter, all of those things probably have liquidity risk. Things on an exchange do not. Anything that trades off of an exchange probably does, okay? So liquidity risk is the inability to sell your stock or stuff at a fair price quickly. Like if you go to sell something that's held by like 10 people, what they call closely held, it's going to be hard to find a buyer. But if you try to sell shares of GE or Gillette or Microsoft or Nvidia, there's always going to be people willing to buy it at a price. You may still lose a little money, but you won't lose as much. It'll be because the price is there, not because you can't find a buyer. So liquidity and marketability risk is a risk that you can't sell your shit at a fair price. Political risk, changes in government laws, coups, or instability can wreck your investment, especially abroad. Now, yes, if you're in the US, you have political risk. But listen, changing from one president to another is not really political risk. It's like an upheaval. Like, I don't know if it's Venezuela. I could forget if it's Venezuela or Argentina. Better example is, I guess it's Venezuela. The better example is Cuba. So in the 40s, all the rich people went to Cuba to hang out because there's a great little island. And then Castro came in and took it over. So all those industries that were there got nationalized and you lose your money. That's basically what it is. So the example is you invest in a foreign energy company, like an oil company, and then the country nationalized the industry, your shit's gone. That's political risk. It's not the fact that we change presidents. That's not political risk. Some people think it is, but it isn't. Oh, I got to call this. Let's step to this. Currency or exchange rate risk, okay? Currency or exchange risk. The value of foreign investments changes based on currency swings. It's also called foreign exchange risk, exchange rate risk, FX risk, okay? So if I invest in another country, like say I invest in British Petroleum, and the pound drops, when they pay dividends, it's going to give me less money, or it's going to be worth less, right? So if you're invested in a foreign country and their currency drops, your stuff is worth less because it dropped in value. Can't buy as much of our dollars. But if it goes up, it's better. So if I'm going to invest in a foreign country and the dollar drops before I do it, that's going to cost me money. Now, there's a thing, call risk. A bond issuer pays you back early when interest rates drop. So now you have to reinvest at a low rate. So it sounds like reinvestment risk, right? So you have a 5% bond. So let's do it this way. You buy a callable bond at 6%. Rates fall to 3%. The issuer will buy the bond back early from you. Now you're stuck with money that you have to reinvest, but the only thing available is 3%. Good. Legislative risk. New laws or tax rules hurt your investment. So if Congress changes tax rules on muni bonds, your tax-free income isn't suddenly tax-free anymore. So if you buy a muni bond, you're expecting tax-free income. What if they say, you know what? No longer are we allowing tax-free interest on muni bonds. Boom, your shit's not tax-free anymore. That's legislative risk, okay? Opportunity risk. You lock into one investment and miss out on better opportunities. So you put $10,000 into a CD at 2%, then a hot new IPO that you were thinking about doubles in a week, you missed it. Opportunity risk is investing in one thing and missing out on a bigger return. You can't control that shit, just deal with it. Capital risk. It's a risk that you lose the money you put in, not just a little of it, all of it. You invest in a startup, they go bust, you get nothing. So again, it's capital risk is a risk that you lose the money you put in, probably all of it. Regulatory risk. Regulators drop new rules that mess with the business model. If the SEC cracks down on crypto exchanges, your blockchain ETF takes a nosedive. Or let's say you have a startup that's creating a new, let's say you own Eli Lilly or something, and they're waiting for approval on a drug, which is basically just pesto anyway. But they're waiting for, or maybe it's a smaller pharmaceutical company that all their money's been put into this new cancer drug, and they're waiting for approval from the FDA. That is regulatory risk. If it gets approved, that's great. If not, it's bankrupt. Prepayment risk. Now, if you have a mortgage-backed security, prepayment risk is a risk that as rates drop, that people will refinance and pay off your mortgage. So a risk that a loan, like a mortgage, is paid off early. It's pretty much mortgage-backed securities. Interest rates fall, homeowners refinance, your mortgage-backed security pays off faster, and you have to reinvest at a lower yield. So I'll say that again. If you buy a mortgage-backed security, you're getting monthly interest you're getting the income from people paying their mortgages. But when rates drop, people refinance. So when they refinance, they're paying off the loan, the mortgage that you had. So now the problem is they only do that when rates drop. So you're going to go to all your money back and go, crap, I can only invest at that lower rate because that's all that's available. Prepayment risk is getting paid off early. Now, on the other side of that is extension risk. So if you have a mortgage-backed security, oh my God, I can't speak. If you have a mortgage-backed security and rates go up, you're still getting the lower rate. So you want to try to get out of it, but it's very hard to get out of a mortgage-backed security. So if you buy a 3% MBS and rates are now 7, your thing's going to be worth less. It's going to be hard to sell it. That's extension risk because you're kind of stuck in the mortgage-backed security. Event risk. A sudden unexpected event tanks your investment. Kind of like the last 2 weeks, okay? But to be fair, everyone knew they were going to do the tariffs, okay? It's a CEO scandal, a lawsuit, or a plant explosion wipes out a company stock overnight. So that's event risk, like a tornado, a hurricane, something wipes out a country or a company, and it wipes out the stock. Strategic risk, I'm going a little deeper now. Strategic risk, the company bets on the wrong business plan or tech. Blockbuster ignored streaming, Netflix didn't, we know who won. That's strategic risk. Strategy is strategic risk. Sovereign risk, a whole country defaults on its debt. Argentina said, sure, we're not paying our bonds. That's sovereign risk, okay? So the whole point here is that sovereign debt is debt issued by a country. Sovereign risk is that the country defaults on its debt. I think Greece did that like maybe 15, 20 years ago. Timing risk, literally my life. You get the investment right, but the timing's wrong. You buy a stock right before earnings season and it tanks short term. Long term, you're right, but ouch. So let's do it this way. I am the king of this. So let's do an example. I needed money. It's April 9th. It's 10 in the morning. I need money to pay a bill. So I sell my stocks, even though I don't want to. I figure I'll get back into them. I sell my stocks with a little bit of a loss. And then Trump goes, we're doing a 90-day pause on the markets, and the stock rips 2,500. The whole market rips up 2,500. It's timing risk. You're just wrong on the time. Beta or volatility risk. This is based on beta. Beta is your volatility measurement. So if you have a beta of 1, you move with the market. If you have a beta of 2, you move twice as much as the market, the same direction. If you have a beta of 0.5, you move less. So if you have a high beta like 2, if the market goes up 10%, you're going to go up 2 times that, 20. However, if the market goes down 10%, you're going to get down 2 times that, down 20%. So that's your volatility risk. So if you have a beta of more than 1, you are more volatile than the market. Better in a good market, worse in a bad market. Here's some risk. So concentration risk is like non-diversifiable. You put all your eggs in one basket. If it drops, you drop. You're 100% in tech. Tech crashes, you're wrecked. You diversify to get rid of that one. Behavioral risk. That's letting your feelings mess up your trades. Panic selling or buying the hype. So like today, the last week or so, after the tariffs, everyone's using panic selling. It's called capitulation in a way. So basically, you're selling at the bottom because you freak out and then it rebounds. Execution risk is your trade doesn't go through how when you want it. I place a limit order that doesn't get filled, or I place a market order and I buy it at a price and it drops. Execution risk is usually when you screw up the execution of the trade. Counterparty risk, that's when you do a trade and the other side doesn't. So say I go to buy 100 shares at 50 and I buy it from some Dewey, Cheatham and Howe. You like them. And then when I go to settle, they disappear, they flake. So what happens is, it doesn't really happen on exchanges, but over-the-counter securities and over-the-counter derivatives, there's a risk of counterparty risk that the other side of the trade will not go through what they're supposed to. Options, swaps, futures for the most part. And I guess it could happen with stocks that are not on an exchange. Duration risk is like volatility. Longer duration bonds are more sensitive to the interest rate risk. Okay, so 30-year bond, remember I do long and low, baby. 30-year bonds move up and down harder than 5-year bonds. Longer duration, higher risk. Social risk, ESG, public backlash or social trends hurt a company's image and stock. A brand gets canceled over scandal like Bud Light, shit like that, okay? And the stock drops. Tesla. Black Swan event. That's Black Swan risk is really when a totally unexpected, rare, catastrophic event happens. Hurricane Sandy, 9/11, COVID, global shocks nobody priced in. Correlation risk is when you thought your investments are diversified, but they all move the same way. So you own tech, crypto, and growth ETFs, and they all crash at once. Emerging market risk, it's basically countries still developing, have more political and economic instability. You invest in Brazil, and the president is impeached. Stock to tax. Okay, good. Tracking error risk. Okay, so tracking error is like if you have an ETF or an index fund that's supposed to match the market, right? But if it doesn't perfectly match the market, that's tracking error. So tracking error risk is like, say we have an ETF and the market goes up, 5%, but we only go up 4.9. That's tracking error risk. The risk that your ETF or index fund will not match the market perfectly. Style drift risk is when a mutual fund strays from its strategy. A value fund starts buying high growth stocks. So again, style drift risk is that a mutual fund that was supposed to be growth starts buying value stocks. Okay, now we're going to try to do some synonyms, and I may miss some. If you have any that you want taken care of, put them in the chat. It's going to be good. Okay, so first, coupon rate, nominal, stated, interest rate. They all mean the same thing. So coupon, nominal, stated rate, and interest rate all mean the same thing. That's one. Yield to maturity is the same as basis. Par value, face value, stated value. There you go. Par value is for a bond par value is redemption value, face value, stated value. Dividend yield and current yield are the same thing. So current yield and dividend yield are the same thing for stocks. Ex-dividend date and ex-date mean the same thing. Debenture means unsecured bond. Convertible bond, convertible debenture. Zero coupon, OID, original issue discount. Callable bond, redeemable bond. Puttable bond, a put bond. That means you can sell it back to the issuer when you want. Overlapping debt and coterminous. That when you have multiple GO bonds from multiple towns feeding into like one school district or one park system or a county whatever. County library, county park system, county high school, something like that. Defeasing the debt, advance refunding, pre-refunding, and escrow to maturity all mean the same thing pretty much. Defeasing the debt, advance refunding, and pre-refunding mean the same thing. Sometimes it's escrow to maturity too. That means you're issuing a bond. You have an old bond at a higher rate. Rates drop. You're gonna oh my God, issue a new bond. Take that money, put it in an escrow account, and then you're gonna pay off the bond at a later date. Okay. As far as options go, intrinsic value equals in the money. Intrinsic in the money mean the same thing. Okay. Exercise price, strike price, same thing. Now this one's a little different. Exercise is the other side of a sign. So if you own an option, you exercise it, which means the seller of the option gets a sign. So I'll say that again. If you own an option, you exercise it if you want. And if you exercise it, then the seller of the option gets assigned the obligation. Okay. Buy, own, hold, long. That's for owning it. And then short, write, credit, sell mean the same thing. Covered call, covered option writing. Uncovered call, naked call. Now, I guess, right, so if they say intrinsic, it means in the money. That's always a big one that screws people up. So remember, if they say, you bought a call and then you sold it at intrinsic, you're just selling it at the in the money amount. Mutual funds and investment companies. NAV is also known as the bid and is known as a redemption price. NAV, they calculate once a day, NAV, bid price, and redemption price are all the same thing. Sales charge means sales load. POP, public offering price. NAV plus sales charge equals POP. Open end means mutual fund. Closed end fund means publicly traded fund and exchange traded fund. I'll say that again. NAV equals bid equals redemption price. Sales charge equals sales load. POP equals NAV plus sales charge. Open end fund means mutual fund. Closed end fund means publicly traded or exchange traded. Initial margin requirement is known as Reg T. Maintenance margin is minimum equity requirement call. Long position, you own it. Short position, you're shorted. So if you're long stock, you're bullish. If you're short stock, you're bearish. Bid, market pricers, market makers, buy price. Ask and offer mean the same thing. Ask and offer, market makers, sell price. So again, market makers want to buy at the bid. market makers want to sell at the ask or the offer. So bid and ask or bid and offer is the same thing. Spread, the difference between the bid and the ask spread. Also spread, it's the same thing though. There's a yield spread, the difference between the treasuries and the corporate yields. Then we have a spread on an underwriting where it's funny, the buy and the sell. It's where the underwriter buys it from the issuer and then they sell it to the public at par, say, okay. Know your customer due diligence. SEC 10b-5 is anti-fraud rule. Inside information is material non-public information. So again, inside information is material non-public information. And a sell-off is bearish. Consolidation means we're neutral. And that's kind of it. I guess that's it. I can't think of any more. If you think of any words that you're looking for synonyms, throw them in the comment. I didn't cover everything. I tried to cover a lot in these videos. I'll do this, have this one out as a standalone, and then I'll push them all together and make one big video that you can fall asleep to every night. Y'all have a good night. Don't forget to check me out every Tuesday night at 8 p.m. We're trying a new thing. I think we're going to start it. No, we're going to leave it out. We're going to start it. We're going to try a new thing where we have half an hour of just test taking skills. We have to figure out when we're going to do it. It's literally just not about products. It's just like how to sign up for the test. So, and a Q&A, people have questions about the mechanics of doing the taking the test, not the actual products, like test taking skills, what you should do, stuff like that. Nothing about products. That'll be for the regular live Q&A. Everyone, have a good night. Stay classy, and I'll see you on the other side.